Numbers don't panic. People do. Let's look at the psychology driving today's market. When prices rise, confidence rises. When confidence rises, behavior changes. And when behavior changes, the market changes with it. The question is, which came first? In most models, markets are supposed to reflect reality. Prices measure value. Investors respond to fundamentals. But what if the act of responding changes the fundamentals themselves? That is the core tension. Markets are not passive mirrors. They are active participants. The act of pricing can change the conditions being priced. And when that happens, the feedback becomes the mechanism. There is a framework for understanding this dynamic. It is called reflexivity. It describes a two-way relationship between what participants believe and what actually happens in the market they are participating in. When investors believe an asset will rise, they buy it. Their buying pushes the price up. The rising price appears to confirm the original belief. The belief and the price reinforce each other in a loop. So we ask a fundamental question. Does market sentiment merely reflect reality, or does it alter reality? And if it alters reality, what does that mean for how we understand price, value, and collective behavior? The observable pattern is familiar. A company's stock rises. The rising stock makes it easier for the company to raise capital. The new capital funds real projects. The projects improve fundamentals. The improved fundamentals justify the higher price. But notice what happened. The belief that the stock would rise contributed to the conditions that made it rise. The market did not simply observe the improvement. The market participated in creating it. From a psychological perspective, this is where collective perception becomes a market force. The crowd's belief about future value can change present conditions, making the believed future partially self-fulfilling. This works in the opposite direction as well. When investors believe an asset will fall, they sell. Their selling pushes the price down. The falling price impairs the company's ability to borrow. The impaired borrowing weakens actual fundamentals. This is where psychology intersects with market structure. The reflexive loop means that sentiment is not merely a reaction to reality. It can become a cause of the reality it appears to measure. The reflexive loop can amplify both booms and busts. In a boom, optimism creates the conditions for its own validation. In a bust, pessimism creates the conditions for its own validation. The direction depends on the prevailing sentiment. Soros described reflexivity as a two-way feedback loop between market participants' thinking and the situations in which they participate. Biased perceptions affect prices, and those price changes in turn affect perceptions. He grounded this in two principles. Feelability. Human understanding of reality is inherently incomplete and distorted. And reflexivity. These distorted understandings can affect the situations to which they relate. Notice the distinction from a standard market model. In the standard model, prices adjust to reflect underlying reality. In a reflexive model, prices can alter underlying reality. The causation runs in both directions simultaneously. In practice, this means that a rising market can create the conditions for further rising. Cheap credit flows to overvalued assets. The funded projects generate real revenue. The revenue validates the price that made the credit possible. Shiller described speculative feedback loops where initial price increases generate enthusiasm that spreads through the investing population, amplifying stories that justify the increases and bringing in further investors. The distinction from simple crowd behavior is important. Reflexivity is not just investors following each other. It is investors' collective behavior changing the economic conditions that they believe they are passively observing. This creates a structural vulnerability. The fundamentals that appear to justify the price are themselves products of the price. Remove the price movement, and the fundamentals that depend on it may deteriorate. So reflexivity describes a market that is not a mirror but a participant. The act of observing, pricing, and investing changes the thing being observed. The feedback loop is the mechanism, and the mechanism runs both ways. Here is the feedback loop in detail. Investors form a collective belief about an asset. They act on that belief. Their action moves the price. The price movement changes the economic conditions surrounding the asset. The changed conditions then validate the original belief. The validation attracts more participants. More participation further moves the price. The loop reinforces itself with each cycle, creating a self-fulfilling dynamic. But the self-fulfilling dynamic has a limit. The fundamentals created by the price movement are dependent on the continued movement. When the movement slows, the created fundamentals can begin to deteriorate. When the fundamentals deteriorate, the belief that was sustaining them weakens. The weakening belief reduces participation. The reduced participation further impairs the fundamentals. The loop runs in reverse. This reversal can be more violent than the ascent. During the boom, the reflexive loop created genuine economic activity. During the bust, the unwinding of that loop destroys the very conditions it created. Emotion can amplify the move. During the boom, optimism is validated by results. During the bust, fear is validated by results. In both cases, the emotion is not just a reaction, it is a contributing cause of the outcome it responds to. Leverage amplifies reflexivity. When rising prices allow more borrowing, and borrowing funds further purchases, the feedback loop between price and fundamentals is mechanically intensified by the credit structure. The narrative plays a crucial role. During a reflexive boom, stories emerge that explain why the fundamentals are improving. But those stories often describe improvements that are themselves products of the price movement. The crowd creates the feedback. Each participant who acts on the reflexive belief adds to the market conditions that validate the belief. The collective behavior produces the evidence that justifies the collective behavior. The process can persist for extended periods. As long as new participants enter and the credit cycle supports the price, the reflexive loop sustains itself. The duration is not predictable from the psychology alone, but the process is inherently unstable. Because the fundamentals depend on the continued operation of the loop, any disruption to the loop threatens the fundamentals themselves. The stability is conditional, not structural. When the loop breaks, the correction does not just return prices to their pre-boom level, it can overshoot because the bust reflexive loop destroys fundamentals that the boom's reflexive loop created. The interaction between psychology and credit is particularly reflexive. Rising confidence improves creditworthiness. Improved creditworthiness enables more borrowing. More borrowing funds more investment. More investment validates the confidence. Look, this does not mean that every market move is reflexive. Some price changes reflect genuine one-directional information. But when the feedback between perception and reality becomes the dominant mechanism, reflexivity is operating. So the mechanism is, perception shapes action. Action changes conditions. Changed conditions validate perception, and validated perception drives further action. The loop runs until it encounters a constraint it cannot absorb. But not every feedback between perception and reality constitutes reflexivity in the strong sense. Some feedback is stabilizing rather than destabilizing. When prices deviate from fundamentals, corrective forces may restore equilibrium. Reflexivity as a framework does not predict the timing, direction, or magnitude of the loop. It describes a structural possibility, not a guaranteed sequence. Whether the loop dominates depends on conditions the theory itself does not specify. Consider that some reflexive dynamics produce positive outcomes. When investor confidence funds productive investment that genuinely improves economic output, the reflexive loop has created real value rather than merely inflated it. The distinction is between reflexivity that creates durable fundamentals and reflexivity that creates dependent fundamentals. When the fundamentals survive the removal of the feedback loop, the value was real. When they collapse without it, the value was constructed. There are patterns consistent with reflexivity. When asset prices and fundamentals move in lockstep during a boom, but fundamentals collapse when prices reverse, the sequence fits the reflexive model. But identifying the reflexive pattern after the fact does not provide a reliable tool for predicting when the loop will break. Reflexivity describes the mechanism, not the schedule. So the thesis holds within boundaries. Reflexivity can contribute to self-reinforcing booms and busts, but it is one framework among structural, institutional, and informational forces. It describes a possibility, not a certainty. Which brings us back to the opening question. Does market sentiment merely reflect reality, or does it alter reality? From a reflexive perspective, it can do both simultaneously, and the interaction between the two is the mechanism. Reflexivity means the market is not a neutral observer. It is a participant whose observations change the observed. The price is not just a measurement, it is a force that shapes the thing it measures. But this is not a complete explanation for all market behavior. Many price movements reflect genuine information arriving from outside the feedback loop. Reflexivity is most relevant when the loop itself dominates the information flow. The value of understanding reflexivity is not in predicting when the loop will break. It is in recognizing when the market may be in a reflexive regime, where prices and fundamentals are co-creating rather than independently determined. Price is evidence of transactions, not a direct reading of emotion. A rising price may reflect genuine value creation, reflexive self-fulfillment, or both. The price alone does not tell you which mechanism is dominant. What reflexivity offers is a framework for understanding why booms can create their own validation, and why busts can destroy the fundamentals that the boom created. It does not predict the timing of the transition. Awareness of reflexivity does not place you outside the loop. You participate in the same market. Your buying and selling contribute to the conditions you are observing. The observer is inside the system being observed. The collective dimension is central to reflexivity. The loop operates not because one investor is biased, but because many investors share similar biases, and their coordinated action is large enough to change the conditions being priced. Reflexivity is one lens through which to understand why markets can create self-fulfilling dynamics. It does not predict direction or timing, but it reveals how perception and reality can become entangled in a feedback loop. Start by asking whether the fundamentals you are observing are independent of the price or dependent on it. If the fundamentals improve because the price rose, reflexivity may be operating. Separate the feedback from the fundamentals. Ask what would happen to the conditions being priced if the price movement stopped. If the conditions would deteriorate, the value may be reflexively constructed. Observe the behavior, not the prediction. When you see fundamentals and prices moving in lockstep, ask whether the fundamentals are driving the prices or the prices are creating the fundamentals. Remember that being aware of the reflexive loop does not place you outside it. Your participation is part of the feedback. Understanding the mechanism does not exempt you from its effects. This framework does not predict when the loop will break or which direction the correction will take. It offers a diagnostic lens for studying how markets create their own conditions. Behavioral interpretation does not reliably predict price direction. Reflexivity offers a way to understand how markets can sustain self-fulfilling dynamics, not to time their reversal. Reflexivity reveals how collective perception and economic reality can become entangled in a feedback loop. That is its contribution, understanding how markets participate in creating the conditions they price. The crowd creates the feedback. Studying how reflexivity shapes market dynamics is essential to understanding collective behavior. This is educational analysis, not financial advice. Markets do not just reflect reality. Under the right conditions, they participate in creating it. Understanding that feedback is the observation, not the prediction. Don't follow the herd. Study it. See you next time.